Some investors treat the stock market like a competition. Every move is about winning. They track prices daily, follow earnings calls, react to headlines, and believe that with enough effort, they can stay ahead of everyone else. Other investors couldn't be more different. They invest once, keep contributing regularly, and barely check their portfolio. No concentrating, no predictions, just patience. Two completely opposite strategies. Both claim to be the smartest way to build wealth. So, who's actually right? Today, we're breaking down one of the most important debates in investing: active investing versus passive investing. We'll explain how each strategy works, what long-term evidence shows, and which approach gives most people the highest probability of success. Welcome to Money Tracks, where we break down investing concepts in a simple and practical way. And before we begin, a quick disclaimer. This content is for educational purposes only and should not be considered financial advice. Understanding active investing. Active investing is built on one central idea: that markets are inefficient enough for skilled investors to exploit. Active investors believe that with the right analysis, timing, and decision-making, they can earn returns above the market average. Instead of owning a fund that simply mirrors a market, active investors choose specific investments they believe are priced incorrectly. They might buy assets they think are undervalued or sell assets they believe are overpriced. The goal is not just growth, but outperformance. Active investing can take many forms. One common method is hands-on stock selection, where investors choose individual companies based on their expectations for future performance. For example, an investor might identify a company expanding into new regions, launching innovative products, or improving profitability faster than competitors, expecting these changes to drive higher returns. Another form of active investing involves strategic allocation, where investors shift money between different asset classes depending on economic conditions. During periods of rising interest rates, they may reduce exposure to certain sectors. During economic expansions, they may increase exposure to growth-oriented investments. For those who don't want to manage investments personally, actively managed funds offer another route. These funds are run by professionals who continuously analyze data, adjust holdings, and attempt to capitalize on market opportunities. Some exchange-traded funds follow active strategies as well, combining professional management with the flexibility of stock trading. Why active investing appeals to many people. The attraction of active investing is understandable. The possibility of earning higher returns feels empowering. It gives investors a sense of control and involvement. Instead of accepting average results, active investors believe effort and intelligence can lead to superior outcomes. Active strategies also offer flexibility. Investors can respond to economic changes, avoid companies they dislike, or shift focus toward industries they believe will grow faster than the rest of the market. For experienced investors, this adaptability can be appealing. However, the reality of active investing is far more challenging than it appears. The challenges of active investing. Consistently outperforming the market is extremely difficult, even for professionals. Markets are highly competitive, and prices already reflect the expectations of millions of participants around the world. Finding opportunities that others have missed is rare, and maintaining that advantage over time is even harder. Costs are another major obstacle. Active strategies usually involve higher fees, frequent trading, and sometimes tax inefficiencies. Over long periods, these costs quietly erode returns. Even if an investor performs well before expenses, the final outcome after costs often tells a very different story. There's also the emotional burden. Active investing requires constant decision-making under uncertainty. Fear and greed can easily influence behavior, leading investors to chase rising prices or exit positions during market declines. These emotional responses often result in poor timing and reduced returns. What passive investing looks like. Passive investing takes a fundamentally different approach. Instead of trying to outperform the market, passive investors aim to participate in the market's overall growth. The assumption is simple. Markets tend to rise over long periods, and capturing that growth is enough. This is usually done through index funds or broad market ETFs that track entire markets or large segments of them. By investing this way, you automatically own a diversified collection of companies without having to choose winners or losers. The philosophy behind passive investing is not about prediction, it's about participation. Rather than betting on which companies will succeed, passive investors accept that growth will come from the market as a whole. Advantages of passive investing. One of the biggest strengths of passive investing is its efficiency. Because index funds follow predetermined rules, they require minimal management. This keeps fees low and allows more of an investor's money to stay invested over time. Passive investing is also highly diversified. Instead of relying on the success of a few companies, investors spread risk across many businesses and industries. This reduces the impact of any single failure. From a behavioral perspective, passive investing is easier to stick with. There's less temptation to make emotional decisions during market volatility. Investors are encouraged to focus on long-term consistency rather than short-term performance. Historically, this approach has produced strong long-term results, largely because it avoids many of the common mistakes that hurt individual investors. The limitations of passive investing. Of course, passive investing isn't perfect. By design, it will never outperform the market. Investors receive market returns, no more and no less. When markets decline, passive portfolios decline as well. Some investors also find passive investing unexciting. There's no active decision-making, no constant feedback, and no sense of beating the system. For people who enjoy analysis and strategy, this can feel unsatisfying. What the long-term evidence suggests. When we compare active and passive strategies over long periods, a clear pattern emerges. The majority of actively managed approaches fail to outperform broad market investments once costs are taken into account. Even when some managers perform well for a few years, maintaining that performance over decades is rare. Market conditions change, competition increases, and yesterday's advantage often disappears. Another important factor is investor behavior. Many individuals earn lower returns in their investments because of poor timing decisions. Buying after strong performance and selling during downturns reduces long-term growth. Passive strategies naturally reduce these errors by encouraging patience and consistency. Choosing the right approach. Active investing may make sense for a small group of individuals with deep knowledge, exceptional discipline, and the ability to manage risk effectively. In certain niche areas of the market, opportunities may exist for skilled investors. However, for most people, passive investing offers a more reliable path. Low costs, diversification, and long-term commitment combine to produce results that are difficult to beat. Passive strategies also promote healthier investing habits, such as regular contributions and minimal emotional trading. That doesn't mean active investing must be avoided entirely. Some investors choose to allocate a small portion of their portfolio to active ideas while keeping the majority invested passively. This approach allows for engagement without putting long-term goals at risk. Final thoughts. The biggest mistake investors make is not choosing the wrong strategy. It's constantly switching strategies. Wealth is built through consistency, patience, and discipline. The best approach is the one you can stick with through both good markets and bad. If this breakdown helped clarify your thinking, consider subscribing and supporting the channel. It helps us continue delivering clear and practical investing content. Thanks for watching, and I'll see you in the next video.